Today I have taken a topic which is regarding the transfer pricing. So before starting, just imagine you are an Indian company and your company is a subsidiary of a foreign company, and your Indian company charges 10 crore as a management fee to a Singapore subsidiary. Sounds simple, right? But 3 years later, the income tax department knocks on your door and says, that price, not at arm's length. We are adjusting 4 crore as extra income. Oh, that is here the penalty of 1.2 crore on the top. So this is transfer pricing. And if your businesses have any transaction with a related party outside India, you are sitting on a compliance time bomb. Today, I'm going to break down everything you need to know in plain, simple language. What it is, why it applies to, how to price your transactions, and what documentation you need, and the game-changing updates in 2026. Every CFO and CA must know. So what is transfer pricing? Let us start with basic. Transfer pricing, when two companies start, let us say two companies are of the same group and a parent and subsidiary and transact with each other, there is a natural temptation to manipulate the prices of these transactions to shift profits to whichever country has a lower tax rate. For example, an Indian company sells goods worth rupees 100 to a Mauritius subsidiary for just rupees 60. The subsidiary company then sells it to a real buyer for, let us say, rupees 100. This rupees 40 is booked in Mauritius, taxed at near zero. India gets robbed of the tax revenue. And for example, the example given is basically transfer pricing manipulation. And to counter it, India introduced transfer pricing regulations through Finance Act 2001 and inserting sections 92 and 92F under the Income Tax Act. The core principle is simple. Transactions between related parties must be priced as if they are between the independent unrelated parties. This is called arm's length price, or ALP. Law was introduced to prevent profit shifting out of India, and since 2001 it has grown into one of the most complex, litigated and high stakes area of Indian taxation. So transfer pricing applies to whom? Number one, if you are an associated enterprise, which basically means the related party in another country, then section 92A says two companies are associated enterprises if one holds 26% or more voting power in other. A loan from one company constitutes 51% or more of others' total assets, and one guarantees 10% or more of borrowing of the other. More than half of the board of the one is appointed by the other. The definition is deliberately wide. Even if you apply 90% of another company's raw materials and influence their pricing, that can make you associated enterprises. Then number two, if you have an international transaction between AEs, that is associated enterprises, then and that international transaction is very broadly classified. Here is an important point. Even if you are a resident third party, not a direct AE, but the actual benefit flows to an AE, the transaction can still be deemed an international transaction under section 92B. Law has eyes quite wide everywhere. Now, what are the methods to determine arm's length price? There are 6 methods. One is comparable uncontrolled price, that is called CUP. Then you have resale price method, then cost plus method, profit split method, transactional net margin method, and any other method. Out of these, the transactional net margin method, that is TNMM, is quite applicable in India, and that is, the compare the net operating margins of the tested party with those of the comparable companies. This is very very much used in India, especially for IT and ITES companies. But whatever method you choose, you need to document why you chose it and how you applied it. Now, what is the compliance? There are 3-tier compliance documentation framework. Tier 1 is the local file or TP documentation. Every entity with international transactions must maintain detailed documentation including functional analysis, industry analysis, comparable analysis, and ALP computation. This is the foundation of your defense in any audit. Then you have to maintain tier 2 level, that is master file section 92D, required for Indian entities that are part of an MNC group with consolidated revenue above 500 crore. It covers group's organizational structure, business description, intangibles, financing arrangements, and financing positions of all entities. Then tier 3 is country by country report or CBCR report under section 286. This is required when your parent group's consolidated revenue exceeds 5,000 crore. The CBCR provides a global snapshot, revenue, profit, tax paid, employees, and assets in every jurisdiction where the group operates. This is transparency tool that regulators love. So, and of course, Form 3CEB. Every taxpayer with international transactions must file this accountant's report signed by a CA by 31st October each year. Failure to file or filing inaccurate particulars attracts significant amount of penalties. Now, what is this? Penalty is a real pain. So let us talk about penalties. This is because transfer pricing gets very serious at this stage. Then you have a section 271A where the penalty is 2% of the value of each international transactions. That is for failure to maintain documentation or furnishing inaccurate particulars. Then you have section 271G. If you don't furnish information or documents to the transfer pricing officer, another 2% penalty per transactions. And then under section 271BA, failure to file 3CEB, penalty of rupees 1 lakh. And there is a secondary adjustment concept introduced in 2017. If the TPO makes an adjustment to your income and you don't repatriate the corresponding excess amount within 90 days, that amount is deemed to be a loan to the AE and interest is computed on it indefinitely. That is why documentation is not optional and it is your insurance policy. Now, once let us consider what are the dispute resolution mechanism. Transfer pricing is also unfortunately India's biggest litigation engine. Transfer pricing accounts for nearly 40% of all tax litigation involving MNCs in India. But there are proactive ways to avoid this. One is Advanced Pricing Agreement, APA. And under this, a deal is between you and the tax authority that pre-agrees the arm's length price methodology for a specified period up to 5 years with a rollback option for 4 years. This APA program has been massive success. In fiscal year 24-25, India signed a record 174 APAs, highest ever. Companies that go through APAs get certainty, avoid audits, and save enormous amounts in litigation cost. Then you have MAP, that is Mutual Agreement Procedure. When there is a dispute involving double taxation, meaning India taxed it and the other country also taxed it. So MAP allows the two countries' tax authorities to resolve it between themselves under the relevant DTAA. It takes time. Global average is around 27 months for transfer pricing MAP cases, but it is often the only way to get relief. And in Finance Act 2025, there is an operational block assessment scheme. This is a brand new mechanism. A taxpayer can now opt up to a 3-year block assessment for transfer pricing. ALP and the methodology determined by the TPO in year 1 is applied to year 2 and year 3, as long as the transactions remain materially unchanged. This brings consistency and reduces repetitive litigation, and rules are expected soon from CBDT. Now let us consider the global picture. What is the global picture? Let us zoom out at the global level. What is happening? Transfer pricing does not exist in vacuum. The global tax landscape is undergoing a revolution, and it will hit India businesses very hard. One is a BEPS, that is base erosion profit shifting. In OECD, BEPS project introduced 15 action plans targeting profit sharing. India was early adopter, introducing CBCR master file, thin capitalization rules under section 94B, limiting the interest deduction to 30% of the EBITDA and significant economic presence provisions. Then pillar 2, that is global minimum tax. This is the most significant and consequential development of the decade. Under pillar 2, any MNC with annual revenue of roughly 7,000 crore in INR must pay a minimum effective tax rate of 15% in every country where it operates. If the local rate is below 15%, the parent company can impose a top-up tax to bring it 15%. And what does this mean for transfer pricing? Enormous implications. If your Indian entity is set up a low margin captive, say earning 8 to 10% returns, and the Indian effective tax rate falls below 15% for some region, the parent group could face top-up tax in their home country. Therefore, transfer pricing policy must now be re-examined through the lens of pillar 2 effective tax rate. Then you have USA, USA government has withdrawn from the global tax deal, and that is after the Mr. President Trump came into power. Now, for smaller and routine transactions, you have an easy way out, and that is India's safe harbor rules under section 10 TD offer a much simpler path. If your transactions meet a specified criteria, tax authorities will accept your declared price. No questions will be asked. And so key safe harbor rules to know is for IT and ITES companies, if your operating profit margin is at least 17 to 18%, you are safe. Then knowledge process outsourcing, higher margins will apply. And intra-group loans in rupees, margin of SBI, MCLR plus agreed spread depending upon borrower's credit rating. And then foreign currency loans, reference rate is plus 150 to 400 basis points depending on credit rating. And then corporate guarantee commission of at least 1% per annum. The safe harbor threshold for eligible transactions was recently raised to 300 crore by CBDT notification 21/2025 dated March 25, 2025. The rules have been extended to assessment year 25-26 and 26-27. This is a great news. It means more businesses can use safe harbors with certainty for next 2 years. But remember, you must opt in by filing Form 3CEFA. It is not automatic. So now let us wrap up our discussion on this. So what should you do right now? If you have any related party transactions with a non-resident entity, 1. Map all your transactions and classify them. 2. Choose the right ALP method and build a defensible benchmarking study. 3. File Form 3CEB on time. Don't miss October 31st deadline. And 4. If you have high value or complex transactions, consider going for an APA. The certainty is worth it. 5. If you are a large MNC group, prepare for Pillar 2 impact analysis on your TP policies today. Don't wait. So transfer pricing is no longer just a compliance checkbox. It is a boardroom issue. Companies that manage it proactively will save crores. The ones who ignore it all the way, it will be more penalty, litigation and reputational damage. If you found that this video useful, please share and subscribe. If you have specific questions on transfer pricing, APAs, methods, penalties, or pillar 2, drop them in comments. I will answer each one for you. See you in the next video.